So this video is about managing our income taxes, and it's actually very straightforward. This one, it basically just goes through how we calculate our income taxes. There are two types of tax regimes all around the world. The first one is called progressive tax, which your tax rate increases as your income increases. This is called a progressive tax, and US federal income tax is progressive. In some countries, there's something called a regressive tax, where your tax rate actually goes down as you make more income. But what's applicable to us is that in the US, the federal income tax is progressive. As far as I know, every state who has an income tax has a progressive income tax. Some states don't have income tax, as far as I know. Texas, for instance, does not have an income tax, but their property taxes are higher, so it compensates that. There's a concept called average tax rate, because we have, and we're going to go through that in a minute, we have so many exemptions, so many deductions. Just because you make X amount of dollars that fall into 25% does not mean that you actually end up paying 25%. Average tax rate refers to your net income tax that you paid, what you paid actually divided by your total income. So again, depending on what sort of situation you are, you will have definitely deductions, exemptions, and even though your gross salary may be at a, I don't know, 25% bracket, likelihood is because of the exemptions and deductions, your taxable income will go down. Therefore, the amount of tax you pay or tax rate will go down, and therefore your average tax rate will be lower than what you thought it will be. So average tax rate is the net income taxes paid and then divided by total income. So how do we calculate our net income? So let's define income to begin with. First, we call earned income. This is wages, salary, tips, commissions, and bonuses. There's usually a form called W-2 that you actually receive on a periodic basis every year, during the tax time. And this, will list if you are working on a salary or you're receiving any wages or tips, commissions, or bonuses, you're going to receive that W-2, which will include all the wages and salary in gross, whatever you actually earned. Now, your employer will deduct taxes as you report your situation to them based on your exemptions, and then they will actually withhold taxes from your paycheck. So actually, you end up paying taxes at each paycheck that you receive. So this is called withholding. When you get a job, you tell your employer how many exemptions you have, what sort of, if you're married, you're single, you got kids, how many kids, and so on and so forth. And they calculate a tax rate for you, and then they will withhold some of your income for paying taxes, income taxes, and then for Social Security, for Medicare, and then whatever is left will be paid to you in your paycheck. Your W-2 form that you receive during the tax period before April, sometime around like early February or mid-February, will include your gross pay, your deductions, your exemptions, and how much withholding that you had, how much Social Security you paid, how much Medicare you paid, and so on and so forth. But this is referred to as your earned income. Your total income includes your earned income plus your interest and investment income. So if you had any money in a checking account and you actually earned some interest, or if you had any dividend payments from stocks that you hold, or coupon payments from bonds you hold, any other interest or investment income goes into your total income. In most of the cases, you're going to receive a document called 1099 that will include your investment activity, if you receive dividends, coupons, interests, and so on and so forth. If you are retired or receiving some sort of a retirement income, you will have to report this within your total income. So these are not considered earned income, but they are included into your total income. And then finally, your capital gains is considered a total income. Now, capital gains is a very specific term. So you buy a stock at $100 and you sell it at $120, you make a $20 profit. This is referred to as capital gains. You buy a house at $10,000 and sell it at $15,000, you just realize a $5,000 capital gain. You bought a car for $10,000 and you sold it for $15,000, you just realize $5 of the capital gains. And this also is reported as part of your total income. So your gross income is your total income minus the exclusions. Now this is what we are referring to as exclusions. So certain types of income that are not required to be reported. So these types of income you do not have to report, although these change quite a bit from state to state and from year to year. So before you make any decisions as not to report an actual income item, you should check whether the tax law has changed, and they do keep changing every year. So it's, err on caution and check before you report or not report. Gifts are usually our exclusions, because the person who given you the gift have to report it, not you. And again, depends on the state, depends on the time, but this is usually the case. And as far as I remember, up to $1 million, you do not have to report it, but the person who is giving you the gift will report it. If you inherited money or property, and this is a highly debated issue, back in the day, there used to be an inherent tax on inherited money or property. Then they eliminated it. Now they're talking to get it back again. Some countries have it. For instance, I'm originally from Turkey, and Turkey has taxes on inherited money or property. U.S. does not. Most of the states in the U.S. do not. However, again, before you exclude this from your gross income, you should check it. Life insurance benefits and almost certainly child support payments are exclusions to your gross income. So your adjusted gross income is your gross income minus adjustments. Now notice, in the gross income, we said your total income, whatever money you made, minus exclusions. These exclusions, and exclusions is a very special term. Exclusions are gifts, inherited money, life insurance benefits, and child support payments. Now, with respect to adjusted gross income, so we went from earned income, total income, gross income, and now adjusted gross income. So we're going from the total that you've earned minus your exclusions that you're allowed, depending on the state, depending on the time. And then now we're talking about adjustments. Now, these adjustments are subtractions allowed to be deducted from your total income. And they're sweet because you basically just deduct them from your total income. That's it, right? So, for instance, if you have any sort of IRA contributions, these are your special retirement contributions that you make every month or at whatever period that you have. There's a cap on this, again, depending on the state and so on and so forth. But these are adjustments to be deducted that you are allowed to subtract this from your gross income. So remember how I said your average tax rate? Even though you think you make X amount of dollars and you fall into a 30% ratio or 25% ratio, you may not, because you have your exclusions, you have your adjustments, you have your deductions, and you may actually end up paying significantly less. So these adjustments are the subtractions that you are allowed to be deducted from your total income. So your IRA contributions, if you paid any alimony, this is allowed to be deducted from your gross income. And if you paid any interest on your student loan, this is also allowed to be deducted from your gross income. Now, you also have deductions. Again, let's recap. You had your earned income, you have your total income. Then we had our exclusions. These are very specific: gifts, inheritance, life insurance benefits, child support payments, and so on and so forth. And then we had our adjustments: your IRA contributions, alimony paid, student loan interest paid. So total income down to gross income, that's after exclusions, and then adjusted gross income, that is after exclusions and adjustments. Now you have deductions. These are a lot more common. So you notice exclusions, the gifts, who receives $1 million gift, right? So these are not as common. Although child support payments, inheritance happens, but not as general. And then IRA contributions, although it's very common, but still something unique. And then student loan interest paid. So deductions are a lot more common, a lot more general. So you have a choice. You could deduct your standard deduction, that's every American, or every taxpayer. You don't have to be a citizen to pay taxes. Therefore, not every American. Every taxpayer have the right to take standard deduction, or you could itemize your deductions. If you take the standard deduction and you're a single person, in 2017, I think it's pretty much the same still, $6,350. And for a married couple, it was $12,700. That's your standard. And you don't have to document anything for this. Basically, when you're filing your form, say, I take standard deductions, and that's it. This much is deducted from your adjusted gross income. Now, if you're going to itemize it, now you're taking the risk of audit because you have to keep a record of everything that you itemize. But you could actually have more than the standard deduction, and therefore it might be in your best interest to itemize it. Although, personally, if the difference is not all that much, I always choose a standard deduction simply because itemizing it, you have to use your own judgment whether it's a allowed deduction or a not allowed deduction. You have to keep your records, and then you are more likely to receive an audit. An audit is Internal Revenue Service reserves the right to come back to you and say, we believe that there may be an error in your tax filings, and therefore we want to audit your records just to see if you did it right. If they find that everything is great, then everything is great. If they find that you made a mistake, then there could be penalties. And if they find that there's intent, there could be criminal penalties, financial penalties, and so on and so forth. So in any case, if you're going to itemize it, then you're allowed to deduct medical and dental expenses. Any taxes that you paid, those include real estate property taxes. And if you paid any other income taxes to the state or your municipality or local government, your foreign income taxes, if you paid any. There are certain interests that if you paid, for instance, home mortgage loans, there's an interest that you pay on your home mortgage. And then loans used for investments, if you pay any interest on those actually, you can deduct it. And then if you made any itemized deductions to charity, cash or goods, although you need to have a receipt if it is actually more than $250. Depending on the state, the requirement for the receipt may be even lower. So these are your deductions. And again, you have the choice of making a standard deduction or an itemized deduction. It's up to you. If it turns out that your itemized deduction is less than the standard deduction, then you just take the standard deduction. So your itemized deductions doesn't have to be as much. But if it is a lot more than the standard deduction, then you should take the itemized simply because it's better for you. However, know that you have to keep an official record of every deduction that you have made, and you are more likely to receive an audit because you had an itemized deduction. The standard deduction is allowed deduction amount for every taxpayer in the U.S., and that's pretty straightforward. Now, there could be some personal exemptions. Now, this is, again, very, very common, and this is something that you have to report to your employer. So how many people do you support or who are dependent on you as a taxpayer? So for instance, I'm married, I have a kid, and I have, I am supporting my my kid. So my exemption is one, my wife is working, she has her own income, and therefore she's not dependent on me. However, my daughter is dependent on me. So if I'm filing with my wife, married couple, then we have one exemption, and that's our kid. Each exemption reduces taxable income by $4,050 and as of 2017. So basically, you get a deduction for every person that is dependent on you financially, as much as $4,000. So at this point, you calculate your preliminary tax liability, and that's your gross income, adjustments, exclusions, deductions, and exemptions. And then you could look at a tax table or tax rate schedule just to come up with what sort of preliminary tax that you're going to pay. Now, there are some tax credits. Now, these are, again, very, very unique, very special tax credits, but these decrease your tax liability dollar for dollar. So say, you need to pay $5,000 in taxes, but you had earned income credit of $2,000, then $5,000 minus 2 is your remainder of your income tax. Therefore, tax credits decrease your tax liability dollar for dollar. Now, these include things like health insurance premium tax, opportunity tax credit, Hope Scholarship, lifetime learning credit, mortgage interest credit, and so on and so forth. Now, once you have those tax credits out of the way, your taxable income will be the gross income that you have here minus adjustments, deductions, exemptions, and then tax credits, and then you have your tax liability. Now, remember I said when you get a job, you tell them your exemptions. These are how many people are dependent on you, and so on and so forth. And then your employer will basically, when they're paying you your salary, your paycheck, they're going to withhold taxes for you. They're going to pay for Social Security, Medicare, and state income tax, and federal income tax, and all of that. Now, whatever taxes that they have paid, they're going to report this on your W-2 form that you received mid-February. Now, based on that, you know how much taxes you paid. Now, this is you paid. Now, after you calculate your tax liability, right? Now, let's talk about an example. Say taxes withheld, right? So say your employer withheld $10,000. And then your tax liability that you calculated, and it turns out that you have an $8,000 liability because you had more deductions. Now, which means you paid more taxes than you should, and now you're going to have a tax refund. And it will be 10,000 minus the 8,000, and you're going to get a check for $2,000 from IRS, right? If, however, it turns out your tax liability is, say, $11,000, in which case you're going to have to pay. So well, you owe $11,000. It was withheld $10,000. Now you got to pay taxes in addition to what's been withheld from your paycheck. In addition, $1,000. Now, it is legal to try to avoid taxes, but it is not. It's illegal to have tax evasion, right? So there are practices that you could employ and try to reduce your tax liability. And the term that's used is tax avoidance. You basically just employ these techniques, if you will, and try to have lower tax burden. But once a tax is a burden, meaning that once the tax is due, you have to pay it. You cannot evade it. There are criminal penalties for not paying taxes. Remember, Al Capone was actually prosecuted on tax charges. So reduce taxable income. There are two things certain in life: death and taxes. So you got to pay your taxes. Whichever country you are, by the way, you got to pay your taxes. So reduce taxable income through your employer. You could have flexible spending account. You can have a contribution, an employer contribution retirement plan. You could have a 401k, which is very common, retirement plan. And you could have your company's matching contributions to your retirement plan. These are all nice ways to lower tax liability, tax burden on your overall income. You could also make tax sheltered investments. So these are, instruments, investments that have tax advantages, right? Their returns have tax advantages. For instance, if you buy a municipal bond, the capital gains tax on that one is tax advantaged. So some of these allow you to invest pre-tax income rather than after-tax dollars, meaning you could deduct this from your gross income before paying taxes, which makes them tax sheltered investments. Right? Now, there are some tax deferred investment growth, and these are traditional IRA and Roth IRA investments for your retirement. They're tax deferred simply because you don't pay taxes now, but you will pay taxes when you retire. So you are deferring the taxes. So that's our discussion about tax for this week, and we'll talk more about taxes in later weeks, but so far, this is about it. Thank you.